Of every account and instrument in this module, one is the load-bearing one, the one whose absence creates the failure mode that takes practices down. And it's not the checking account most coaches expect. The checking account is the engine. The tax reserve savings account is the shock absorber. Engines fail visibly and you fix them. Shock absorbers fail invisibly until you hit something hard, and then the damage is structural. The tax reserve is the one you set up before you're ever convinced you need it, because by the time you're convinced, the September estimated payment is already due. Without the reserve, every quarterly tax deadline becomes an emergency. With the reserve, the same deadline becomes a calendar event. You log in, you transfer the amount the worksheet tells you, you move on with your day. The difference between an emergency and a calendar event is whether the money was set aside on the day it came in, or whether you're now competing with rent and software bills and your own paycheck for cash you already spent. Same revenue, same tax liability, completely different lived experience of the 4 payment dates the IRS expects you to hit. What this account is mechanically: a separate business savings account held at the same bank as your business checking or at a high-yield savings provider with one explicit purpose: accumulating funds to pay quarterly estimated taxes and any year-end balance due. The money inside the account doesn't belong to you. It belongs to the IRS and to your state if your state has income tax. You're holding it in trust between the day it came in and the day it goes out to the tax authority. Naming the account itself helps. If your bank lets you label accounts, label it tax reserve, so every time you log in, the boundary is visible. The reason this account is load-bearing is structural to how self-employment income works in the U.S. tax code. A W-2 employee has income tax and FICA withheld from every paycheck automatically. You, as a self-employed coach, get the full gross deposit, and the IRS expects you to estimate your own liability and pay it in 4 installments: April 15th, June 15th, September 15th, and the following January 15th. Coaches who don't reserve get the gross deposit, treat it as available cash, spend it on operating expenses or personal expenses, and arrive at the deadline with no money to pay. The reserve account is the mechanism that makes spending the tax money structurally impossible. The 30% shortcut is the most common piece of self-employed tax advice on the internet, and it's wrong for most coaches in most years. Your effective tax rate depends on 4 variables: your business net income, your deductions, your filing status, and your state income tax rate. 2 coaches with identical gross revenue can have effective rates that differ by 10 percentage points based on those 4. Module 15.3 is where you'll calibrate the actual percentage from your actual numbers using a worksheet. For Module 6.4, 20% is a low-stress starting approximation that under-reserves for very few coaches and over-reserves slightly for many. Better to over-reserve and refund yourself in January than the other direction. The per-deposit transfer beats the periodic monthly sweep, and the reason is behavioral rather than mechanical. $2,000 lands in business checking today. You transfer $400 to the reserve today at 20%. The reserve is funded before you have a chance to mentally reallocate that $400 to anything else. The $1,600 that remains in checking is your actual operating cash, and you treat it as such. A monthly sweep means 30 days of looking at $2,000 in checking and unconsciously expanding your operating decisions to fit. By the time the sweep runs, the $400 has already funded an expense you didn't consciously charge to tax money. Never touch it framing is what holds the boundary in place when cash gets tight, because cash will get tight at some point in year one for almost every founding coach. A crunch arrives, a client cancels, a slow month happens, a surprise expense lands. The reserve is not where you go. Operating cash is the first layer. An operating reserve, which Module 16.3 covers, is the second layer. The business credit card from the next unit is the third layer. The tax reserve stays untouched because the money inside it already belongs to a third party. Treating it as available cash is a category error that compounds when the tax deadline arrives and you don't have the money you spent. Two composite coaches make the structural difference concrete, and they have the same revenue in the same year. Priya opens the reserve in month 1, transfers 22% on every deposit. Module 15.3 runs in month 4 and calibrates her actual rate to 19%, so she has a small surplus building in the reserve. September 15th arrives. She logs in, transfers the estimated payment to the IRS from the reserve. No emergency, small surplus left. Marcus defers opening the reserve, spends the revenue across the year on operating costs. September 15th arrives. He pulls $3,800 from his personal savings to cover the estimated payment, takes an underpayment penalty in April because his estimates were short, ends the year owing $2,100 more than Priya despite identical revenue. Open the tax reserve methodology worksheet and open the savings account today. Pick a starting percentage, 20% if you haven't run module 15.3 yet, the calibrated number once you have. Transfer that percentage from your most recent business deposit as the first move. That single action proves the system works before any deadline arrives. Mark the calendar entry as recurring on every deposit receipt. Same day. With the email, confirmation is the cleanest anchor. Adjust the percentage when 15.3 calibrates to your actual rate. The habit is the durable part of this system. The percentage is just the dial. Checking open, reserve activated. The next video covers the third account in the separation structure. The business credit card used as a separation instrument and a rewards instrument, never as a debt instrument, paid in full monthly from business checking. The discipline is identical in shape to the per deposit reserve transfer. The right behavior at the right time, automated where you can automate it, structural rather than willpower based.